Assalamu alaikum friends, welcome back to the next video of account receivable. So this is about disposing of account receivable. By disposing of we mean selling of account receivable. So sometimes there are some financial companies who buy your receivables, right, um, on some discount, so that you get immediate cash, whereas they get the cash eventually when the receivables are due, and they charge the difference as the service charge. Because collecting the receivables, if I am selling goods on credit, I can collect my receivables on my own, but in order to collect I have to do the billing and collection, which are often costly, I mean activities. So rather than calling the customers, following up for the payment, and then sending the person to collect the cash or maybe checks, and then reminding him again and following up again. What I can do, there are some companies operating, financial companies operating in the market, so I can sell my receivables to them. So if I have, say, receivables of 1 million rupees, so I can ask them, okay, you can buy these receivables and you just pay me maybe 950,000 for these receivables of 1 million. So you will receive 1 million rupees for my receivables and you pay me 950,000 by now immediately. So I have sold my receivables. So effectively, this is a sort of a finance cost and interest, right? So that's why this activity is actually not a Sharia compliant activity from the Islamic perspective. So how do we account for it? So let's say if we have receivables of 600,000 that we sell for to a company who charges 2% of the amount of receivable as a service charges. So my account receivable that I have sold are credited, right? And I get immediate cash, right? So immediately I have received cash, not exactly equal to this amount, but 98% of it, because 2% is a service charge. So I debit cash by 98% and I debit the service charge by 2%, which is 12,000, right? So this is a sort of an interest expense or service charge expense. Better, we can debit it to interest expense or finance cost as well, which is an expense. So although there are some more details in it, that is, sometimes there's a uh, factoring with recourse and sometimes there's a factoring without recourse, which means that sometimes when we sell receivables, we still uh, uh, bear the risk of non-payment. That is, if the customers eventually don't pay, uh, the factoring party will come to us that, okay, your customer is not paying, pay to me, thing like that. So this is known as with recourse. And without recourse means that we have not only sold the receivables, we also have sold the risk and reward of those receivables. So if in without recourse scenario, if the customer doesn't pay, it is the factoring party who will bear the loss, not us. But again, this is I think beyond the scope of your syllabus, so you don't need to consider this for assessment, but just for the sake of your knowledge. So for the assessment purpose, you just need to know this one, right? Okay, moving forward, credit card sales. So credit card sales, what, just think about it, credit card sales. There are three parties, right? The one party is actually the credit card company, the MasterCard or the Visa. The second party is the retailer who is accepting credit card, and the third party is the customer. So when customer pays us with the credit card, we get immediate cash, right? But the customer doesn't need to have pay cash, right? So the customer actually has the credit, and this credit is awarded by the credit card company, not us. So now how should we record? Just if you recall the accounting equation, we are receiving cash, so cash is debit, right? Cash is debit, right? And from where we are receiving cash, we are receiving cash against some revenue, so revenue is credit. And if the credit card company is charging us some service charge, for example, if the credit card company says that whenever a customer comes to you and pays you through credit card, so we will not give you 100%. But by cash mean, in American books, keep in mind, right? By cash mean bank, because whenever somebody pays with a credit card, our bank balance increases, right? So by cash in US books, usually it means bank. So you can write it bank as well. So the amount goes into our bank account, but not 100% of the sales, right? So if the customer is paying 6,000 and the company is charging 3%, for example, or 0.3% as a service charge, then service charge expense is 180 and we get the bank balance, bank or cash debited by 5820, right? So this is just like factoring of account receivable, right? So we have actually sold our receivable to the bank, to the credit card company. So now the credit card company actually has to book the account receivable. So again, this was very straightforward. Moving forward, now the next topic is the notes receivable, right? So this is a documented credit. Let's read how they defined it, a notes receivable, right? So let's zoom it in. Companies may also grant credit in exchange for a formal credit instrument known as a promissory note, right? So this is a legally executable instrument uh, on which a stamp duty has been paid and all the legal compliances are there and witnesses, the signs of the witnesses are there. So this is sort of a promissory note which is known as notes payable for the person who is on the other side, whereas it's a note receivable for a person who is on the receiving side. It's a written promise to pay a specified amount of money on demand or at a definite time. They may be used when individuals and companies lend or borrow money, right? So I can just take some loan from bank and sign a notes payable so that bank keep the notes payable document with it. It means it's notes payable for me, it's notes receivable for bank. So bank give me cash as a loan against notes payable, right? So what entry I will make? Cash debit, notes payable credit. What entry bank will make? Notes receivable debit, cash credit, right? So this is the kind of instrument they show. Okay, a notes payable always usually carry some amount of interest, and keep in mind whenever interest as a percentage is mentioned without any qualifier, that whether it's a per month or, so the percentage is actually annual rate, right? So uh, whenever the percentage and interest percentage is mentioned, it is, unless it is mentioned this is X percent per month, then it is per month, otherwise the percentage is annual percentage. So let's see its accounts, its accounting. The first thing over here is the maturity date. So usually uh, uh, the note is denominated in terms of number of days or number of months, right? So let's see how do we calculate the maturity. So okay, three ways of the maturity date of a promissory note. On demand, I promise to pay. So if the note is on demand, it means whenever the bank will ask you, you have to pay, right? On July 23 to 2020, I promised to pay, right, on a stated date, right? So we pay, the date is mentioned that the note is becoming due on July 23, or the note is becoming due after 1 year from now, for example, right? So from now, 1 year, so we can calculate the date. So now they given as an example. When the life of a note is expressed in terms of months, you can find the date when it matures by counting the months from the date of issue. For example, the maturity date of a 3-month note dated May 1 is August 1. So if the note is executed on May 1 and the credit period is given as 3 months, right, then the note matures on 1st August, right? A note drawn on the last day of a month matures on the last day of the subsequent month, right? If it is again a 1 month note. That is, a July 31 note due in 2 months matures on September 30, right? So this is the last day of the month. So again, we are not supposed to count 30 plus 30 days because the note is denominated in terms of months. So if note is denominated in terms of days, we have to count days. If the note is denominated in terms of month, we have to count month. Now it says when the due date is stated in terms of days, then we need to count the days, right? So for example, they say over here, the maturity date of 60-day note dated July 17, right? So July 17, we count 60 days, July 17 onwards. So July is 17 to July 31 because the day on which you have taken the loan is actually counted. So 14 days, right? And then August 31 days, so 45 days. So how many more days we need in for September? 15 days to make it a 60-day note, right? So it means that the note will become due on 16th September, right? So keep in mind, there is one date on which we take the cash from bank and there is one day on which we repay the cash to bank, right? So the first day is counted in the credit period, the last day is not counted in the credit period. So when it is a 60-day note, the and the transaction took place on July 17. So July 17th is counted in 60 days. But on the day we are repaying the note, it is not counted. It means from July 17 to 60 days is the credit term, and on the 61st day actually we are going to repay. So 15th days of September, it means by 15th September, it is the credit terms complete. On 16th September, we are going to repay the loan. So in order to make this calculation easy, just assume that all the transaction took place early in the morning at 9 o'clock. So on July 17, 9 o'clock, it means the entire day actually has to pass. So the day is to be counted. Whereas on the repayment, we repay on 16th September, 9 o'clock early in the morning. It means the 16th September is yet to pass. So that's why it's the 61st day. But that one day doesn't matter that much, I think, but you should be able to understand it. Now, how to calculate the interest, right? So whatever the face value of the note, how much amount of loan you have taken, 20,000, multiply with the annual interest rate, multiply with the time in terms of 1 year. So maybe if it is a 2 month note and 2 months have been passed, so 2 upon 12, 1 month note, 2 month note, 1 month is passed, so 1 upon 12. So let's see some examples and fill. So a $730 note, 12% for 120 days. So the interest will be 730 into 12% into 120 is denominated in days. So days 120 upon 365. But for the sake of ease, we usually take 360, right? A 9% note, $1,000, 6 months. So 6 upon 12, right? The face value multiplied by interest rate. A 2000 note, 6% 1 year. So 1 over 1. So 1 year complete. So just 6%. We don't need to multiply it further by any factor, or just 1 over 1. Now the issue comes when actually we have to record interest for the partial period, right? And that is something for which you have to count the number of days to record the interest, and that we will see in the next video. Okay friends, so valuing notes receivable, again this is the same thing as we discussed in the account receivable allowance for doubtful accounts, right? So it's exactly the same treatment, but we don't usually take the allowance method in the notes receivable academically, so you just leave it, right? Just keep in mind that just like in account receivable we recognize the expected estimated bad debt expense, so we can do for the note receivable as well, although academically usually this is not a case. So you just replace the word account receivable with the word note receivable, right? Now disposing of not receivable, then eventually when we collect the amount, so from the receivable side, right? Since this is the chapter for receivables, so we are actually doing accounting for the receivables. So on our note receivable, when we eventually receive cash against the note receivable, right? So we debit cash, right? So keep in mind earlier what entry would we have been made. So let me show you the over here. So when I have given the loan on note receivable, so the entry I would have been made, right, is notes receivable debit by say $10,000, and cash I would have given credit $10,000, right? So this is the entry that I would have made when I issued the note, right? When the note is signed by the person who is taking loan from me. So I would have made this entry. Now when he, after 3 months, after 2 months, whatever the period of the note is, when the customer pays me back, he also pays the interest. So I debit cash by the amount that I receive along with the interest. So whatever the interest, the calculation follows. So for example, over here you can see this was a 10,000 note. It was dated on June 1. So this entry was actually on June 1 for this particular example. So it was June 1, right? Let's make it, align it. Okay, so this was June 1, and let's do it as well, this entry. And accepting a 5 month. So this was a 5 month note, 9%. So it means it will due on November 1. So 5 months complete are November 1. So November 1 it is getting due. So we'll receive our money back on November 1. So 9% multiply by 10,000 multiplied by 5 upon 12. So this is how the interest is calculated. So 375 we will receive more. So cash debit 10,375, note receivable debit 10,000, and interest revenue or interest income is credited by 375, right? Now what happens if during this period, during 1st June when the note is executed and the 1st November when note is collected, there comes the period end, for example month end or quarter end, then we have to record the amount of interest which is due but not received, that is accrued revenue. So how do we record it, right? So let's say another example, let's say we do our accounting annually on September 30. So September 30 comes before 1st November. So on September 30, we have to make adjusting entries. So, and in order to make adjusting entries, we have to record all the outstanding revenues and all the outstanding expenses and adjust for the prepaids and earnings. So from June 1 to September 30, there are 4 months, right? So 4 months, although the party has not paid me interest, the party will pay interest on November 1, but interest is due at least for the 4 months. So when I am preparing my financial statements, I should record the interest which is due for 4 months, right? So that's my asset now. It's my money which I will receive from him. Not, keep in mind, not this amount, not for 1 month, not 75, because if the customer immediately pays me, he will just pay me for the 4 month, even though the note is 5 month. But if somehow we agree that you are paying it, the customer pays me right now, the person who has borrowed the money and pays me right now, then of course he will pay me 4 month interest. So that's why we say 4 month interest is due at this point on September 30. So we calculate the interest for the 4 months, which is 300 in this case. You can follow the calculations, and we record an accounting entry as interest receivable, debit, and interest revenue credit, right? So this is the for the 4 month. So if the period end is on 30th June, then we would have record for 1 month, then for 31st July, another 1 month, 31st August, another 1 month, and this way interest receivable will keep on increasing, right? If it is a monthly closure. And then when we collect cash on November 1, eventually we will collect the entire amount, right? So 10,375, the same example follows. Note receivable is credited by 10,000. Interest receivable, which we have already recorded for 4 months, is also credited now, so that interest is received. And $75 which are extra received is actually on November 1, it is actually the income of the previous period from September 30 onwards. So this has to be recorded as an income. So now you see interest revenue is actually split in two periods, right? So because we have closing, we have a period end. So 4 months income is recorded in September period, and 1 month income is recorded eventually in November 1. So that's the case probably when we are doing the annual accounting, right? Every September 30. If we are doing monthly accounting, then this entry would have been made every month by say just $75, right? So dishonor of note receivable, if the customer doesn't pay note receivable, then what we do, we actually debit, rather than debiting cash, we debit the account receivable, because the customer not only has to pay 10,000, note is due, note is overdue. So when the due date of the note passes away, it crosses the due date, it doesn't remain note receivable, right? So the calculations of interest will stop, and all the other things stop. So we have now to go for the legal proceedings to recover the amount from the party who has borrowed the money from us. So we debit account receivable, right? So now we will receive this amount by any way. We credit note receivable by 10,000, and we create interest revenue with 375. Although the customer is not paid, but he has to pay interest as well as the original amount. So we will now pursue through the legal agents and actions to actually recover this amount if the customer doesn't pay. So that's it, I think. Let's see. Now presentation and analysis. So this is again I'm going to cover in the next video. Thank you. That will be the last video.